Collections phase, slides, doesn't matter about the slides. Its current collections is October 1 through January 31st of the following year. The prior year, current collections until January 31st, and then February 1st, prior year's delinquent collections are delinquent until collected. Learning objectives. At the conclusion of this section, students should be able to list and explain duties of the collector, define the following terms: tax certificate, tax lien, tax warrant, list 2 types of tax offices. Identify the elements of an effective delinquent tax collection system. State the normal due date and delinquency date. Explain that a delinquent tax incurs penalty and interest, and list 6 circumstances in which a refund is automatic. Describe the procedure for obtaining a refund that is not automatic. List and define 2 types of legal action for collecting delinquent taxes. And define redemption. Collections and the tax cycle. The due date. The due date is the date the bill is received. No.
Hold on. Okay.
What happened?
It was cranked up to 100 again.
Oh. So, due date. The date the bill is received, usually around October 1st. Taxes are referred to as current taxes from the time they are levied until the date they become delinquent. Delinquency date, usually February 1st of the following year. Taxes are referred to as delinquent taxes if they remain unpaid on or after the delinquency date and they begin to incur penalty and interest. July 1st of the following year is the date penalty reaches the maximum and collections are usually turned over to attorneys. If the last day for a taxpayer to perform an act, such as pay taxes, falls on a weekend or holiday, the last day to complete the act is automatically extended to the next business day. For example, January 31st is the last day to pay taxes before delinquency. If January 31st falls on a Saturday, the last day to pay before delinquency is automatically postponed until Monday. Types of tax offices. Standalone collector or assessor collector. Consolidated offices. 2 or more taxing units operate a joint office by law or by contract or by governing body requirement. Typical collector functions: to receive payments, to receive payments of current taxes and delinquent taxes, penalties, and interest. To issue receipts. A receipt is a written document indicating that a tax was paid. Receipts must be written only if the taxpayer requests one. However, in some cases, receipts are mandatory, and receipts must contain the tax roll account number, and receipts must contain property description as it appears on the tax roll. The collector must also deposit funds, post transactions to accounts, post payments to tax records, balance the accounts, send notices to taxpayers, and issue refunds. Automatic refunds are, the taxpayer does not need to apply for these, and they must be granted. They are corrections to the appraisal roll certified by the chief appraiser, and they are corrections to the tax roll. There are also homestead exemptions granted after the chief appraiser certifies the roll. They are rollback election tax reductions. They are court-ordered appraisal roll changes. And they are duplicate payments. One person pays exactly the same amount on the same account that has been previously paid by another person. Also, under refunds, non-automatic refunds, the taxpayer must apply for and taxing unit officials must approve for overpayments the taxpayer pays too much, or erroneous payments the taxpayer pays on the wrong account. There's a 3-year deadline. The collector and auditor must agree, and governing body approval must be required, or may be required. and the taxing unit must notify a taxpayer of an overpayment of $5 or more and must include a refund application with the notice. Let's see what issues the collector also issues tax certificates. A tax certificate is a signed certificate or form that shows any delinquent taxes. It shows penalties and interest. It shows costs and expenses associated with a previous tax foreclosure sale. The purpose of a tax certificate is intended to protect buyers from purchasing property that has delinquent, omitted, or potential rollback liabilities they may not know about. It is extremely important to correctly research taxes for a tax certificate. If property transferred is accompanied by a tax certificate that erroneously fails to indicate delinquent taxes, penalties, or interest when in fact there are amounts due, the taxing unit loses its ability to foreclose the tax lien on the property. The purchaser does not have to pay if he was not given notice of the lien, and owners as of January 1 remains personally liable. If a property is transferred accompanied by a tax certificate that fails to include property because of its omission from an appraisal roll, the taxing unit's lien on the property is extinguished. The purchaser is not liable for the delinquent taxes, penalties, or interest on the omitted property. A tax certificate must warn the purchaser of land that qualifies for ag or timber valuation that a rollback tax may be imposed if the purchaser changes the use of the property. The collector must charge a fee for the tax certificate, and the fee cannot exceed $10. Reports revenues monthly and annually to the taxing unit of the governing body. That was the other thing that a collector does. Delinquent collections. Elements of an effective delinquent collections system. They mail bills and notices on time, keeping good address records, and taking legal action to secure payment when other efforts fail. A delinquent tax accumulates penalty and interest. Penalty is equal 6% upon delinquency for the first month, typically February, and it increases an additional 1% each month. It peaks at 12%, which is typically on July 1st, where it remains permanently. Interest is 1% for the first month the tax is delinquent and increases an additional 1% each month until the tax is paid. Additional penalty, optional if a taxing unit uses a private collection law firm. Usually imposed on July 1st, it's provided that the taxpayer has received notice, up to 20% of the total unpaid amount, and covers costs of hiring a collections attorney. See penalty and interest table on the next page. So, what? Oh, I was. So the penalty, this is penalty, interest, and percentages.
You don't have to read that.
Oh, okay. Delinquent tax notices. Taxpayers sent one or more notices of delinquency. Collectors send notice of delinquency once each year to every person on the delinquent roll. Some tax offices send several notices. And the notice must include a statement concerning the availability of tax deferrals and the right to pay homestead taxes under an installment agreement. The taxing unit usually mails follow-up notices, and attorneys may send warning letters. If suit is threatened, it must include a statement concerning availability of tax deferrals and the right to pay homestead taxes under an installment agreement. Legal actions. A tax warrant for personal property. A collector obtains a tax warrant from a court. Collector seizes the taxpayer's personal property. The property is sold. Seized property does not have to be that on which tax is owed, and the law allows cities and counties to seize and sell abandoned real property in a similar manner. See Property Tax Code, Chapter 33, Subchapter E. Suit to foreclose tax lien, real property. Tax lien is a legal interest that gives the taxing unit the right to have the property sold if the tax is not paid. The legal procedure for obtaining a court order to have the property sold is referred to as foreclosing the lien. Taxing unit files suit. After trial, court orders sale. Sheriff or constable sells the property at a public sale. Property owners may buy the property back within a certain period. This is referred to as a redemption of the property. To redeem property, the delinquent taxpayer must repay the purchaser what he or she paid and various added fees and penalties. Redemption is much more expensive than paying on time. Special provisions concerning payment of taxes on homesteads for 65 or older, disabled persons, disabled veterans, and surviving spouse or child who is qualified for an exemption under Property Tax Code 11.22 or 11.132. A person may pay taxes in 4 installments throughout the year. A person may file a tax deferral affidavit with appraisal district or a court. The taxing unit is barred from taking further action to collect taxes, and taxes owed incurred interest at a reduced rate, 5% annual rate. The deferral lasts as long as a person occupies the homestead, and on the 181st day after a property no longer qualifies for the deferral, the taxing unit may begin collection activities. The tax office reports and records monthly and annual reports. The typical records are a tax roll, a current year delinquent tax roll, a cumulative delinquent tax roll, copies of newspaper notices, meeting announcements, and records showing dates on which legally required activities occurred, records of current and prior year's tax rates, accounting records of tax payment records, refund records and receipts, partial payment records, deferred payment records, installment agreement and records. Residential property owners who have been granted an exemption under Section 11.13 have the right to an installment agreement that must be at least 12 months in length and may extend no more than 36 months. The tax collector is not required to enter into an agreement if the owner had an installment agreement within the preceding 24 months. During the period of the agreement, if the owner makes all of the payments, interest will accrue on the delinquent tax, but penalties will not be added. Prorating taxes. Occasionally, an exempt property will become taxable during the year. The collector should be able to calculate the amount of tax due for a portion of the year. First, determine if the date of the property became taxable. Next, calculate the percent of the year it would be taxable by dividing the number of days taxable by 365, and the tax for the full year is multiplied by the calculated percentage. For example, a property becomes taxable September 10th. The tax for the entire year would have been $1,825.50 if the property was taxable for the entire year. Calculate the tax for the portion of the year the property was taxable. So 113 days taxable divided by 365 equals 0.3096. $1,825.50 times 0.3096 equals $565.17. Prorated tax is $565.17. I have to ask a dumb question though. Where does the 113 come from?
Oh, from September 10th to December 31st.
Okay. That's what I thought, but I needed to ask to